All right, the one thing that I've learned being so old is that sell-offs happen, bull markets happen, bear markets happen. Invariably, 80% of the time, stocks go up through all of that, but the gyrations in between are jarring. Then along the way in my well, not so illustrious career, I've had a chance to talk to some really smart people. I place Robert Prechter easily in that group. This man is really the father of the socioeconomics, if you look at it, and drawing mood and how it translates into the behavior, buying and selling habits. Robert Prechter, kind enough to join us. Robert, good to see you again.
Good afternoon. How's my old friend?
Very well. Well, not poorer as well, but that's okay. It's only money, as you like to remind me. But one of the things I always am intrigued, and I love having you on, Robert, you step back and don't look at this as just a money-only, data-dependent issue. That sometimes we are what our creature, emotions are, and that it drives our behavior. You were saying back in January when we last had, I hope I'm quoting you correctly, extreme market optimism has consequences. We were presumably in that extreme phase back in January. Ironically, the Dow is kind of back where we were then. But what do you make of this social mood, this socio-economic environment?
Yeah, well, I wrote a book called The Socioeconomic Theory of Finance, and the idea is that the market really is not buffeted by news, as many people think. There are waves of social mood, and they direct people's feelings, and those feelings turn into actions. The big key to understanding financial markets in that context is that when emotions and mood get too strong on one end, it's time for things to turn around. But the interesting thing of the past year or so has been that these indicators that we follow of the long-term expressions of optimism have been breaking records. And we were very content to be hiding in treasury bills and two-year floating rate notes and a few other safe things like gold stored offshore and just watching investors take the market to the final waves up, or what we think are the final waves up. And, bear markets are tricky and they're very swift and they catch people by surprise. So it's much better to be safe in advance than try to react later.
So what is happening now?
All right. Well, to me, the key is to not worry too much about the day by day. I mean, it's kind of incredible to realize that just last Wednesday, which is only 2.5 trading days ago, at least 5 indexes had closed at new all-time highs. And some of them were big ones, like the New York Composite Index, the Dow Jones Composite, S&P Mid-Cap 600, and so on. And so we've only been down for 2.5 days, but you can see once the bear bites, how much it can take away in a short period of time. So what I would say is stay focused on the long-term indicators. And when they've recently been at the stock market has been the most overpriced and overowned it has ever been. So we're going to very calmly just sit and wait. And when everything changes and we see indicators on a long-term basis that are back, at least in neutral, if not bullish, then we'll change our minds. But right now we just say stay in your bunker and watch the show.
There you go. Hopefully on Fox Business. But let me ask you, when you say, stay in your bunker, for how long? I mean, is this a bear market that's starting up now or down? Yeah. Or is this just a head fake and it's an opportunity for, you to come in and pounce in and get some buys?
Yeah, great question. Well, here's a really useful example. I've been showing a ratio, what I call a speculative conservative ratio. It's the NASDAQ 100 divided by the Dow Jones Utility Average, which is, the conservative side of things. Do you know those two things were priced basically the same? They had a 1-to-1 ratio throughout the entire 1980s and into the early 1990s. It's incredible. And at the 2000 top, the ratio got to 17-to-1 because tech was so popular. In 2021, the ratio got to 18-to-1 because tech was even more popular. Well, this past month in July, it got to 23-to-1, breaking all records. So we're not going to fix that ratio in 2.5 down days. I think it's going to take a very long bear market to get us back to normal. And as we spoke last time, mutual funds have only 2% cash. What does that tell you? It tells you that they think there is not even a chance of a pullback for them to add on. They want to be fully invested at current prices. And That's the kind of attitude you see at the top.
So let me ask you then, bear markets are varying length. If we are in fact heading into one, and there's some people, Robert, who dispute that notion, as you know. We had the 73, 74 experience. That was painful. We, of course, went through the financial meltdown, 2007, 8, 9. For that, it took the NASDAQ close to a decade to return to the old highs. So where are we in this?
Well, one of the arguments, in fact, you and I discussed this last time we talked, was that the bulls were saying, don't worry, when the tech mania is over, we'll all rotate into the mid-price stocks and everybody will be happy.
Right.
Well, it turned out that actually they managed to pull that off for about 2 weeks in July. In fact, 1 week in July, the inflow of money into some of the mid-cap funds was the highest since a week in, guess when, 2007. So these kind of moves are indicative of highs when everybody's all excited, but never in history has there been a market that got thinner and thinner and thinner and then suddenly got broad and widened out into a big bull market. It just has never happened. So we think the thinness was a symptom of a market that was focusing on fewer and fewer individual stocks. And in the past, 1929 is a great example, but it's happened other times as well. When you get that kind of thing, it usually continues to climb on those few stocks until the weight of the whole thing finally brings the averages lower. So is the top in? Well, we think so. We've thought that a couple times and we were wrong. But I'll tell you what, we don't have a bottom here of any consequence. So if you're waiting for a bottom to buy, I think there's a lot of time ahead.
Yeah, we forget that the NASDAQ, which is in full correction territory, down more than 10%, I think now 13% from its highs, they were reached just 3 weeks ago. The S&P 500 similarly in correction territory from highs reached, again, a few weeks ago. So because we climbed so far and so fast, is it a given then that to unwind that, it doesn't happen so fast, and that it could be a more drawn-out process?
I wish there was such a thing as a given in the financial markets, because many times when I thought things were given, they're not. But what I can give you is a lot of facts, and we've already covered a number of them, and they do show that the optimism is entrenched. It's the most overowned market ever. There are other interesting things going on in the background, and I know you've talked about these probably on your show. For example, the Federal Reserve had a wonderful opportunity last Wednesday to lower their Fed funds rate by a quarter point, and they didn't take it. I think that was a big mistake. Now, we have followed Fed policy, not just our Fed, but the central banks of other countries as well. And what they do is they follow the free market interest rate with an average lag time of 5 months. Well, the Fed decided to do the usual lag time, even though the 3-month Treasury bill had gone from a 5.5% yield down to under 5.2. So they really had a big chance there to lower their Fed funds rate. They didn't take it. I think there's going to be a surprise rate cut before the September meeting, because I think rates have started to fall even faster.
That's interesting. Yeah.
Choice. Yeah, but of course, last time they lowered.
We rarely see cuts or hikes in between meetings. They have happened. I'll flip that around, and not from a technical point of view, but how the markets would respond to that. Wouldn't they panic at a pre-September meeting rate cut, even all the more?
Yeah, well, I don't think we can predict what they'll do on a particular day, but let's get some perspective on the longer term. And the big argument is always, when the Fed lowers rates, it's going to be bullish for stocks because you can borrow money cheaper. But let's remember that they lowered rates from mid-2007 all the way to the bottom in 2009. And they went from 6% or something to virtually zero. The entire time the market went down. It was the biggest bear market since 1929-32, led to the Great Recession. So lowered rates are no panacea. In fact, they're probably a reflection that the economy is slowing, and that's only one of several indications that's beginning to happen.
Well, to validate your point, we're seeing rates crashing down, but you know what else is down? All the home builder stocks in this environment.
Exactly.
And that's been happening for quite a few days now. And I'm just wondering what you make of that, because this should be a hospitable environment for even banks, for certainly home builders and mortgage and finance companies. But it ain't happening. Why not?
That's correct. And, lumber's down 25% in the past 5 months. Something's going on in the housing sector, and we're already seeing it, of course, in commercial, where they're starting to sell properties for half of what they used to be worth. And in at least one case, I think they sold it for 2.5% of what it used to be worth. So we're seeing rough waters in the stock market. We're seeing them in the real estate market. I think it's going to spread to the corporate bond market. You know that the Fed's balance sheet, and this is really worth noting, I think we might have even mentioned this as well last time, is down 20%. That's a huge drop in what is essentially the base money supply. But during that time, instead of debt contracting along with it, debt has expanded to absolutely record levels at every level of society, from the lowliest family trying to get along all the way up to the wealthiest speculators and even the federal government. The debt is exploding everywhere, and it's on a very small base of money and a very small and shrinking base of money. So you've got so many crossguards coming in, which is why I keep saying, well, let's be safe. And to get there, I wrote a piece called Preparing for Difficult Times. If you don't mind a shameless plug, if your viewers want a copy, they can just come to ElliottWave.com, and we'll be happy just to give it to them.
Wow.
If they're not safe now, it's a good time to get there.
I hear you. Real quickly then, where is a safe place to put money right now? It's been in Treasury notes and bonds. I've seen that. Today it's in the Japanese yen. I wouldn't have predicted that. But what do you do?
Well, we've been saying for quite a while, keep your money safe. And I think the safest one, temporarily at least, is U.S. Treasury bills, at least 2-year floating rate notes. I think it's important to find a safe bank. I looked all over the world to find what I think is a really safe bank that we've recommended to people. Gold is a good thing to have in difficult times. I'm not saying it's going to go way up, but it could. We'll see about that. I think we're heading into deflation, so that's arguable. But the main thing is, look, don't adopt a linear point of view. The markets are not linear. We live in a fractal world, not a linear world, and people are saying, for example, there was an op-ed this morning in a major paper that said, oh, whatever you do, don't touch your portfolio. Don't let this, this down day rattle you and so forth. So why are they saying that? Because they're taking a trend that's been going on a long time, and they're linearly projecting it into the future and saying you don't have to worry, the market's going to go up again. We've heard projections of S&P 15,000 in 5 years. Right at the top of NVIDIA at $140, the head of global development said, oh, we're just at the beginning of the trend. So again, there's massive linear extrapolation going on when people should be realizing that, hey, trends change at all degrees.
They do, but that linear argument holds out a good deal of the time. So you can understand why people come to that perspective, that if you have a longer term perspective, it's better for you. I'm at the age now, and I joke with you about it, Robert, where longer term is really kind of lunch sometime tomorrow for me. But I do wonder how you guide people in that regard. What is the time horizon an investor should look at?
Everybody's different. I mean, we have services. We follow the markets actually 24 hours all day long. So there are people who are watching the Elliott Wave situation intraday. We also have monthly services. We have Global Market Perspective that is 100 pages every single month, covers every major market in the world. So it depends on the type of person. And I'll give you another example. We have a flash service, and my little genius guys who run it on the 11th of July recommended buying the triple short, the 3X short technology ETF. And we've had a heck of a few weeks in that. So we're trying to help people at every degree of trend at ElliottWave.com. That's what we do. It's a fractal situation, as I said before. So we try to analyze everything from the shortest term to the intermediate to things to trends that last centuries.
July 11th was right when we hit our all-time highs for a lot of these indices, the tech indices in particular. Robert, always good seeing you. The only thing I'm upset at you, Robert, you're not aging like I am, and I'm very resentful of that. But it's always good seeing you, my friend. Thank you very much. I think that's it. We have a lot of people getting indigestion after hearing you, but we need to hear the full picture. So thank you. Very good seeing you.
Safety allows you to digest very calmly and happily and sleep well, too. I hope you sleep well tonight, Neil.
All right, so do I. Thank you, Robert. Good fun.